Hello, I'm Russell with Community Financials. Our business makes self-managing HOAs and condos easier by providing monthly accounting and administrative help nationwide. To further assist community boards, we are starting a video series called Ask an Expert. In this series, we pick industry experts and have them share with us their insights to help you operate your community more effectively. A confusing topic for many board members is the annual tax return. To help simplify this topic, I've invited Jeremy Newman and Beth Belanca from Newman CPAs to have a conversation with us. Thank you for joining us. Jeremy and Beth, why don't you tell us a little bit about yourselves?
Thanks, Russell. We've been performing audits and tax returns for associations in roughly 8 states for about 10 or 11 years.
Great. So I'm sure over that period of time, you guys have done about 1,000 tax returns, given that footprint.
We have done thousands, and
every
year we do about 2,500 a year.
All right, awesome. So thank you for agreeing to talk with our audience today. That qualifies you certainly as experts in this topic. So let's get to it. Why is it important for associations to file taxes?
Well, it's required. State and federal statutes require tax returns to be filed for associations so that they're reporting their taxable and non-taxable income and expenses.
So there are some smaller communities who, and you've come across them as well, and they don't file taxes because they figure that they're a nonprofit corporation, and so they just haven't done it. So tell me what happens when an association, whether they're large or small, doesn't file taxes?
Well, typically it might be a change in management company that suddenly says, hey, where are the tax returns for the previous years? Or the state or the IRS sends a notice and says, we understand you haven't filed. You've never filed, or we're missing 2002 through 2012. And then we have to produce tax returns. The difficulty sometimes is that information is not always available for those years. Mm-hmm. So then what do? We're in a situation where we may have to estimate numbers. But even if you're an exempt organization, you are required to file a tax return on an annual basis.
So what is the penalty to an association that doesn't file?
Well, we've seen non-filing for certain entities of $50,000.
Wow. And so you have fines, and then it also puts the association's corporate status at risk, right?
Absolutely, yes. Suspension by the respective states, having to reapply, get reactivated. You can't enter into any contracts and act as a corporation.
Right, and then you also can pursue any collection activities against delinquent owners at that time also, which is a huge problem and risk for associations. So those are just a couple of monetary fines, having to pay for probably some additional back work for all of those years that taxes weren't done, because that's got to be sort of investigative accounting, and then also putting your association's corporation at jeopardy where you can't legally enter into contracts and go after collection activities. So those are a lot of good reasons to file your taxes on time. So are there any types of associations that don't have to file a tax return?
I don't believe we've come across any, have we, Beth?
No.
There are.
There's a number of different tax forms that an association might be required to file for federal purposes. There's 2 or 3 or 4. And for state purposes, there's a couple different formats. But I would say if you're formed as an association, whether you're incorporated or unincorporated, you still would have at least a federal filing requirement.
Okay. And but the broad majority of associations are going to have to file just like everybody else, a state and a federal tax return.
Correct.
Mm-hmm.
What time of year does this happen? Does the association's fiscal year end kind of dictate that? I'm just curious.
Yes. So depending on what your fiscal year end is, if it's December or if it's any other month out of the year, you're going to have a tax return due at the end of your fiscal period, 3.5 months after the year end. So a lot of associations will have a December year end. And so their tax return will be due on April 15th of the following year.
Okay.
And so then similarly, if you've got a January year end, you're going to add 3.5 months after the end of January. So it would be due May 15th and so forth.
Okay.
We can file a tax extension request, which is an extension of time allowed to file the return, but not to pay the tax due, if any. So the extension would be filed for April 15th for a December year-end client, and they would still owe the tax on April 15th, but then they have an extension of time to review the tax return, get the board members' required signatures, and file everything by October 15th.
Okay, great. And in the the thousands of returns that you do a year, what percentage of them actually have to pay a tax? Is there some sort of what's your experience?
Well, it really varies. For most associations are taxed on non-member income items, typically bank and certificate of deposit interest income.
Okay.
If they have a cell tower, lease income, any other business where the source of revenue is from a non-member, external. So that really dictates how much tax you're going to pay. Obviously, you're going to have some deductions to offset against that income. So it's difficult to say a certain percentage pay tax. Small associations without a huge amount of money aren't usually earning very much at bank interest income, so they're very unlikely to pay any tax.
Okay.
Bigger associations with millions of dollars in the bank and $50,000 worth of interest income a year are going to pay a fair amount of tax.
Okay, great. And if I get this question often, if a board has extra, they didn't use all of the money from their common charges, and they have money left over, and they're going to transfer that to the reserves. And I get the question, do we pay tax on that money that's left over and transferred to reserves? So
that is a very tricky area.
Mm-hmm.
It's probably one of the trickiest areas for associations. And a lot of it depends which tax return is filed. My understanding is, from what I've read over the years, roughly 85% of associations around the country file federal tax form 1120H, the H standing for Homeowners Association. And there's very little issue with excess operating funds that it's not typically taxable. If you file a regular form 1120, a corporate return, and try and push a homeowners association's operations into a corporate return, then you are potentially going to run into an issue if you have excess income. It's very difficult in a few words to explain the whole thing because it has this multifaceted. But I think the most important thing is be very careful if you do have excess income. You should be at a minimum having the members approve a revenue ruling 70-604 resolution on an annual basis to either roll forward that excess to the next year or return the excess to the members or the owners. But beyond that, it's a one-year rollover. So if you have years of cumulative operating income, then eventually that becomes taxable after year one.
That's for if they're filing the corporate return, right?
That's exactly right.
If they're doing the H, the 1120H, and they're just going to transfer that excess funds to a reserve account, they're not subject to having to pay tax, right?
That's correct.
Right.
You have to be careful on the transfers. You want to make sure there's transparency in terms of telling. You're effectively changing the budget. Yeah. So making sure that you've been transparent in your communication with the owners via open board meetings, minuting, internal board resolutions to transfer the money. Those kind of things are very important to do.
And you show it on the income and expense report as reserve contribution or something.
Yeah, we encourage clarity on all those things. Transfer Make sure it's transparent on the statements, so you break it out separately.
And you'll see it on the balance sheet.
Yep.
Great. So what pitfalls are there for associations? I see some associations that, a board figures, they do their own personal tax return. A board member who just got on is going to try and file the association's return. So what pitfalls have you seen for that? And, that's probably when it gets to be a little bit more of a complex association.
Do you have any thoughts on that, Beth?
I do. I can speak to that. So I think one of the common things that we see for an association is when they fall out of tax exempt status in California. That was kind of one of the things that we touched on earlier in our conversation here. But for California taxpayers, you can apply for a tax exempt status by filing a special form. It's called Form 3500 exemption application. And this is different from federal tax exempt status, which is a much bigger and more involved process to apply for. But I would say that probably 80% of the California associations that we prepare are tax exempt in California. And with that exemption comes some special requirements that they have to do for tax purposes. They have to file a special tax return, which is Form 199. It's basically just an information report that qualifies them for the exempt status. Mm-hmm. And so what happens is if the association, for whatever reason, neglects to file their tax returns for 2 or 3 years in a row, in particular that Form 199, the state will suspend them and will revoke their tax exempt status, which means, again, like we were talking about, means they can't defend themselves in court, they can't collect, they can't file a lawsuit because they've been suspended mm-hmm. in the state, so they're not in good standing.
That's a major pitfall.
That's a major pitfall, and it just involves, we would need to get them back into good standing by filing those delinquent tax returns, making sure that they pay all of their outstanding liabilities, and then filing that Form 3500 request to reclaim their exempt status. Probably another, not necessarily a pitfall, but one of the things that we commonly see is when an association doesn't pay their estimated taxes, just like individuals, how we're required to pay throughout the year for money that we're earning. An association would need to do the same for California, is that if they had a liability in the prior year and they didn't make any of their estimated tax payments for the next year, but then when they go to file their tax return, they have a big tax liability, they're going to get assessed with underpayment of estimated taxes, which is sometimes a bit of a surprise to them because, they just it fell through the cracks, or like Jeremy was saying, maybe they switched management companies and the tracking of those payments just fell by the wayside. So it's important that if an association has, an amount of interest income or other non-member income that they pay tax on, that they stay, keep track of their payments and stay on top of what their tax liability is going to be.
Great. And now a follow-up question to that is, if you're involved with that association and doing their tax return, is that a service that you guys offer as, those helping with those estimated tax?
We do. That's a good question. So when we prepare a tax return, we also provide the estimated payment calculations for the following year. Mm-hmm. But keep in mind that estimation is just based on the information that we have available to us. Right. So if an association earned, let's say, $10,000 in interest last year, we're going to prepare the return based on the $10,000. We're going to prepare our estimated payments for the next year based on that $10,000. So if that number is expected to radically change, or say they sold a unit, say they got some film revenue or other type of non-member income, that it is not going to be included in what we calculated for the
The
estimated.
board should let you know, so then they can do a catch-up payment or
Exactly. So
something.
it's kind of a two-way street. You know, we're helping them, but they need to help themselves by letting us know if that number is fluctuating.
Excellent. I like the film income. That sounds interesting.
We
Yeah.
get that a lot in
California
California. That's a California
It's a
thing.
Los
yes.
Angeles thing, I
It's
think.
a Los
Yeah.
Angeles thing.
Cool. So just what are, are there some rules of thumbs you can provide for how pricing tax returns work? Any examples, like a small community under 30 units, they're an HOA, it's approximately between this and this amount, or over 100 units and they have additional investment accounts and income streams and cost centers, then then obviously it's got to be a one-off basis where they talk to you and find out. But just for, is there anything you can share with watchers?
We tend to be fairly flat fee on the tax returns. So if we're filing an 1120H, and if there are state returns, depending on where the association is located, our fees are in the high twos to the mid 300s. And then if we're filing Form 990, a federally tax exempt form, those are more in depth, and a Form 1120 where there's more work related to the exempt income, things like that, then those are between $300 and $600.
Great. Well, I think those are very reasonable fees, especially what I've seen in the marketplace. So that's terrific.
Okay.
Is there anything else that I didn't touch on that you guys wanted to add, or do you think we covered HOA and condo tax 101 pretty well?
Well, I think the one thing I would say is all board members should be very aware that they are signing those returns. Usually they're signing those returns.
Under penalty of perjury.
Yes.
It's an important document.
It's an important document, and even though they may not be tax experts, they should hopefully be asking the right questions of the tax preparer to make sure that all the most significant bases are being covered, that all income that should be declared and presented on the return is presented, and that expenses that are used as deductible expenses are appropriate and not overstated.
Mm-hmm.
In other words, to minimize the tax exposure.
Yeah.
So it's an important thing, and don't just wash your hands because someone else is claiming to be a professional and preparing the return on your behalf.
Right. Good point. Well, Jeremy and Beth, you've done an awesome job explaining tax returns today, and I want to sincerely thank you for sharing your wisdom with our audience. If they want to reach out to you and learn more, how can people find you? Do you have a website they can go to?
We do. It's HOACPA.com, and it has our contact information on there and some other hopefully useful information.
Terrific. I'll put a link to that in the notes section of the video down below. And thanks again. And that wraps up today's Ask an Expert video. Keep an eye out for new videos on our YouTube channel and subscribe if you want to see more videos like this, or see the resources page of communityfinancials.com. Thank you for watching.
Thanks, Russell.